There is something that's bothering me right now, and I want to show you why it should bother you too. During 2025, gold and US stocks have been going up together at the same time, and according to the Bank for International Settlements, which is basically the central bank for all central banks, this is something that hasn't happened in over 50 years. Think about that for a second. Gold and stocks rising together at the exact same time is like seeing a black swan just casually walking down your street. It's so rare that when you see it, you have to ask yourself, what is actually going on here? The Bank for International Settlements released a report recently saying that both gold and the S&P 500 have entered what they call explosive territory, which is their fancy way of saying bubble conditions. Gold is up about 60% this year, which is the best it has performed since 1979, and the S&P 500 is up about 18%. But here's the part that makes this really interesting and actually kind of concerning. It's retail investors, people like you and me, who are driving both of these prices higher. This is important because if retail investors are the ones pushing prices up, then retail investors are probably also the ones who are going to panic and push prices down. So let me explain the technical side of what's happening right now, because understanding the mechanics is really important. Now, pay attention to this. The Bank for International Settlements, let's call it BIS from now on, found something called explosive behavior in both assets using statistical models that look at price movements. These models are basically designed to spot what looks like an economic bubble forming. When a price goes up explosively like this, it usually means the price is disconnected from the real value of the thing you're buying. Okay? Normally, you would see gold and stocks move differently from each other. Gold is supposed to be the thing you buy when you're scared and you want to protect yourself, okay? Stocks, on the other hand, are supposed to be the thing you buy when you're excited about the future and you think the economy is going to do well. You are not supposed to be excited about both at the same time. That simply doesn't make any sense. But that's exactly what's happening right now, and there is a reason for it. I know this part might be a bit boring, but trust me, now it's the time to pay full attention. As I mentioned, the data shows that it's mostly retail investors who are putting their money into both gold and stocks right now, while institutional investors like pension funds and hedge funds are actually pulling their money out. In fact, gold ETF prices have been trading at a premium to their net asset value, which means the supply cannot keep up with demand because so many retail investors want to buy. Simple as that. This basically means that you've got too much money chasing an asset and not enough people willing to sell it at, let's say, reasonable prices. When that happens, prices get disconnected from reality pretty quickly. But believe it or not, there is a deeper story to this, because this technical stuff is just a sign of something much bigger happening in the economy right now. Gold has risen because people are getting really nervous about a few things. So let's break them down. Number one, we had massive inflation after COVID, and even though inflation has come down, people are still worried about it coming back. Second, and that's really important, there is all this geopolitical tension with Ukraine, China, Venezuela, and other conflicts around the planet. And people always buy gold when they're worried about conflict, okay? Third, central banks around the planet have been buying massive amounts of gold to diversify away from US dollars and build up their reserves. When central banks buy something, it sends a signal to everyone else that it's worth buying. And the final and most important thing of them all is you not hitting the subscribe and like button. Okay, back to the video. So here's where it gets really interesting. Stocks are up because of artificial intelligence hype, okay? The top 10 companies in the S&P 500, companies like Nvidia and Microsoft, are all benefiting from this AI boom, and they are pulling the whole market up with them. Meanwhile, regular people, retail investors, are looking at the news and seeing stories about gold hitting record prices and AI making people rich. And they naturally think, I want some of that, okay? So what they do is that they start buying, which pushes prices even higher, which creates more news stories, which attracts even more retail investors, okay? It becomes like a feedback loop. This is called herd behavior, and the BIS specifically warned about it. When investors all start doing the same thing at the same time because they are following the crowd and they are afraid of missing out, it amplifies the price swings and makes the market more fragile. The macro picture here is that we've got a situation where retail investors are the ones supporting markets right now, and institutional investors are pulling money out. That basically means if retail investors suddenly change their mind and start selling instead of buying, there is nobody big and powerful wanting to buy what they are selling. The market becomes less liquid, less stable, and we all know how this ends, okay? Now, we cannot ignore the human psychology part of it, and this is important. People sometimes are greedy, and other times are scared, but right now, they are greedy. When they see an asset going up, they don't want to miss out on their gains, okay? This is called FOMO, or fear of missing out, and trust me, it's a very, very powerful motivator. Researchers found that when investor attention goes up, measured by Google searches and social media posts, it actually causes stock or crypto prices to move in sync with each other and with other assets. Now, imagine you're scrolling through your phone and you see a new story about gold hitting a new record, so you decide to buy some gold ETF, okay? Then a few days later, you see another story about the stock market hitting new records, so you buy some stocks too. You are not really making a decision based on analysis, okay? You are just reacting to the headlines. That's human nature, and that's what's driving a lot of what we're seeing right now. Here's the thing though, all of these explanations are true at the same time. It's not just the technical bubble signals, it's not just the macroeconomic story, it's also the human psychology and retail investor behavior all working together. The technical signals are telling us there is a bubble. The macro story is explaining why people are scared and buying gold and are also excited about stocks at the same time. The human psychology is explaining why both are happening at the same time. They are all connected, and that's what makes the situation particularly dangerous. Central banks buying gold sends a signal. Inflation concerns are real. Geopolitical tension is real. AI is transforming companies. These are all real things that justify some price increases, but the rate at which these prices are increasing and the fact that retail investors are the only ones buying right now, that's not really justified by fundamentals. That's purely psychology and herd behavior. The technical bubble signals are basically confirming what the macro story and psychology are telling us. Prices have gotten ahead of reality, and reality is going to catch up eventually. Usually when that happens, it's not really pretty. So here's what the smart investor thinks about all this. The smart investor believes both gold and stocks have some real support underneath them. He thinks gold should be valuable given the geopolitical uncertainty and central bank demand. He also thinks some stocks, especially in AI, have some real growth potential. But he also doesn't think both at the same time should be going up like this, and he definitely doesn't think the pace of increase is, let's say, sustainable. Alright? The BIS is basically saying the same thing. They found that historically, when gold and stocks both entered explosive territory before, like in 1980 or during the dot-com bubble, there were sharp corrections. Not immediately, but they eventually came. Now, here's what that means for cryptocurrency and Bitcoin. Bitcoin and other crypto assets typically move with stock market sentiment. When stocks are, let's say, hot, money flows into crypto. When stocks are scared, money flows out of crypto. But there is also something else here. When you get a situation where retail investors are the ones pushing prices up across multiple asset classes and institutional investors are pulling out, crypto becomes especially vulnerable because crypto is the most liquid asset. Think about it this way. If retail investors pile into gold, stocks, and crypto all at the same time because they are chasing returns and then something happens that makes them scared, they are going to sell the easiest thing to sell first, which is, you guessed it right, crypto. They can sell Bitcoin 24/7, okay? They cannot sell their house on a weekend. They can't sell gold coins or bars as easily. So Bitcoin takes the first and hardest hit. It drops first, which confirms everyone's fears, which makes them sell their stocks and gold too. That's basically the domino effect, okay? So here's what I want to know from you. Do you think the Bank for International Settlements is right about this double bubble in gold and stocks? Do you think real investors are indeed chasing these bubbles right now? Or do you think this is actually justified and gold and stocks can just keep going up together? Let me know your thoughts in the comments below. This is a genuinely interesting economic question and I'd love to hear what you think. If you made it this far into the video, you clearly care about understanding what's really going on with your money and the markets. So hit that like button, subscribe if you haven't already, and as always, thanks for watching and I'll see you in the next video. Bye.